Welcome to the MUFG Global Markets Podcast. I'm your host, John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, August 10th, 2021. Welcome back to the podcast, George.
Good to chat with you as always, John.
Yeah, for sure. So let's dive right into it. So it feels like we can finally move away from phrases like the never-ending and unrelenting to describe the great bond market rally off the March lows. You've discussed that rates may be trying to form a bottom here. You've highlighted this a number of times on your podcast as well as in your notes and conversations. So I guess the obvious question is this it? Is this what we've been waiting for? And in addition, why don't you give our listeners an update on your latest macro positioning and directional views?
No, John, this has really been a nail-biting experience for the last 3 or 4 weeks. I know as those have been following along, we turned neutral duration without really wanting to chase this rally over the last month or so. We got down in July 20th to at least using the 10-year as a benchmark down to close to 1 1/8, and we had a lower bound target that we'd moved twice for the quarter of 1 3/8, and then we moved it down to 1 1/4, and then we blew through that, and since then we've been kind of consolidating and having a go at trying to curve a bottom out over the even though it's been a rally more than a sell-off, not this last week's withstanding move, but in general, we've been stuck between like 1.1, let's call it, to 1.3. But today and yesterday, and really on the back of the NFP number, it seems to be like we're kind of trying to break free from that tight range and move back up to higher rates. The tricky part is, and as I've both written about as well as described, we've seen plenty of head fakes in the past, and this sort of move and consolidation / potentially forming a bottom is happening during the summer months, which are notoriously bond friendly months from a seasonal perspective, where rates tend to stay low or even head lower before markets kind of digest what the remaining of the year really has ahead in September and October. So it's an interesting time to kind of try to call the bottom in rates. The move here does feel like it's a real move. It's a double bottom. We got down last week when ADP missed down to again almost close to that 1 1/8. We failed that day, and largely because not because of the data, because what we've seen all throughout this big rally, it's been this kind of frustrating experience, especially for those that were short along the way, is that the data actually was pretty good, and inflation was actually stronger than many were anticipating throughout the last 3 months. And yet rates kept going lower and lower. Really, this kind of contrarian type move, not making any sense. As we've been highlighting, and as the information is borne out, a lot of this was positioning. A lot of it was these technical one-off factors, and just markets adjusting to a market where rates will stay low for longer. But in our view, we thought that rates got a little bit too low, and so now we're trying to and climb our way back up. I think in terms of positioning, we're in a much better spot here. With the passage of time, I think that's true. The challenging part of positioning at this point of the year, and for those that were either in short positions already, that might be reluctant to put them back on. Premium has been spent, and so it could be that we might not see a lot of just new kind of trades put on, or not similar trades like there were like at the beginning of the year, like these reflation trades 2.0 might not come back in the same fashion or form. But nonetheless, what could happen instead is some profit taking from those that were long the market, and as we kind of get a little bit higher in rates, they want to preserve their P&L. So it's kind of a changing in mentality around positioning. Was a driver of the short covering / rally to lower rates, and maybe the rise up in rates will be more contained because there'll be more position longs being taken off. And I think that's potentially what's happening here if this were to continue. I mean, the macro, we had a great NFP report, so we really cannot find any faults there. And it's, that plus the revisions to the prior month. And if we were to see the continuation of those sort of job numbers, it does put the Fed in play, which is a key macro variable for overall, rates dynamics. and especially vis-a-vis what it means for the tapering process and when it gets launched, which we discussed before many times. So I think all of this is kind of bringing us to a point where it could be the starting point of a bigger sell-off into the third quarter into the fourth quarter. But we have a couple of near-term hurdles, which you've heard me describe, and I think that they lie really immediately next.
You make a convincing argument there. You have perhaps a material change in positioning as well as, a macro change with the Fed potentially being in play. As you say, clearly data has to deliver to get this move, but it's certainly an interesting thesis to consider. So on an administrative note, we're recording this podcast on Tuesday, August 10th, one day ahead of both the CPI release and the highly anticipated 10-year auction. As you've been mentioning in conversations with clients, this week's auctions will be a key litmus test for demand, not to mention them coming at a key time for what's next for the path of long-term rates. Perhaps you could elaborate a little on what exactly you mean by that.
Sure. And as I was suggesting in the first part of our interview, this August seasonals is a phenomenon well documented in the bond market where rates tend to rally or at least stay low during the latter half of the summer months. And what we've seen in periods where there's a strong July type rally, which is not normal, August tends to kind of continue that. And again, there's no certainty in any of this, and this is not guaranteed to take place. That's why if rates are indeed trying to head higher from here, and they were to continue beyond tomorrow's release of the CPI as well as the 10-year auction, that gets us closer to the middle of the month. And then, the next, point of focus for markets will be Jackson Hole. And given everything that we've heard so far from Fed speakers, again, starting really last week with Clarida coming out with a more hawkish tone in the way he was describing things, and then all the other Fed speakers since then have been much more on the hawkish side and almost wanting to pull forward this taper expectations. If they're trying to line things up for more information being dispersed and disseminated in the Jackson Hole, then eventually a September taper announcement, it feels like the Fed is trying to talk up rates. And that's a pretty formidable kind of force to go up against if after we've had a decent rise in rates, if we don't see a rally after the 10-year auction or CPI, this rate move can continue, and then the Fed kind of then can guide us up towards north of 140, close to 150 when they actually do the tapering, which has been my overall thesis and forecast for the third quarter up-down type move, where we thought rates would rally first, not as deep or as sharp as they got to, but we thought we'd head lower first before heading higher. I think that would be the kind of turn that would get us there if we don't see a follow through from the 10-year auction and the 30-year after that. And then we get the August seasonals are negated this time, which is a very powerful message. And then September, we get an even higher push up in rates if the Fed were to deliver the taper and if the data were to be strong. I mean, then there's a lot of ifs thrown in there, but so far, many of these ifs have been delivered. We've gotten good jobs data. It most likely will continue into August and September as the economy continues to reopen, the Fed's in play, and you've now made a double bottom in rates, and you've gone through the supply thing. I think this is very symbolic from that point of view. And so that's what I'm looking for. But now, having said all that, the 3-year auction, which we just saw, was a pretty good auction. It's not in the same sort of vein as the 10-year and 30-year in terms of significance, but it was well subscribed. And it could very well be that, with rates inching higher, this was just a concession trade to push up rates into the auction process, and then we kind of chop sideways. So that's also a possible scenario. But with the Jackson Hole at the back half of the month and being such a critical Fed period in time with policy potentially changing soon, I don't think we're going to get a full August sort of unwind of this sell-off that we've had. And we either chop sideways or head higher, and then that will then put us on the path towards this higher, longer-term rate path that I've been describing since joining.
Okay, great. So I guess for clients that are looking for a little bit more, George just put out a note entitled July CPI Preview and Market Implications. I'd encourage you to check that out. And if you aren't receiving George's strategy notes directly, please email your MUFG sales coverage or get in contact with George directly. He's available via email or Bloomberg. Great stuff as always, George. Thanks for joining us.
Thanks for having me, John.
Thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.